What's up, everyone? It's Karthik with MoneyVest. So here we are in the last and final FOMC meeting of 2025, the widely expected last and final, third and final rate cut of 2025, also coming in from the markets here. Thank you so much for joining, and we are ready to do this as we are heading into the close of a spectacular year for the markets. And of course, from a monetary policy standpoint, inflation has been edging up, or it has been a little bit more elevated. Unemployment has been edging up as well. So we are going to listen in to what Jay Powell has to say in now less than an hour away from the FOMC meeting. And of course, the interest rate projections, the SEP, the summary of economic projections, as well as the statement comes out in less than 30 minutes. Do me a favor and share this live stream with as many people as you can so we can have a lot of people join us during this FOMC live stream. So I've shared the link for the live stream that you can essentially copy paste, share it with your friends, family, other traders, and investors so we can get this party going as Jerome Powell takes the stage to wrap up the entire year of 2025. Meta right now is selling off. I did close out my covered calls for a 75% profit. I'm actually planning on opening up new ones. I should have taken that opportunity at 653 because since then it has been plummeting down over 1.3%. Tesla basically flat. Nvidia also going down about 1.2%. Volume has been a lot lower in this market. As mentioned in our private live stream, we talked about it earlier in the day as the volumes have dropped anywhere from 30 to 60% in some cases. For example, Palantir stock, 60% lower volume as what we're used to seeing on a 30-day average basis. We got QQQ slightly down about 30 basis points. S&P 500 is essentially flat right now, and volatility creeping up over 17. Right now, it's up almost 90 basis points at the moment. So here we go. We do have the poll going on right now. So definitely participate in the poll. Powell's tie. Is it going to be red, blue, or purple? Definitely cast your vote. My prediction is going to be on purple because he usually does wear a purple tie on these meetings. I don't think I can't even remember the last time I actually saw him in a tie, anything but purple. But definitely make your predictions, and we are ready to go here. Also, do drop a like, subscribe to the channel if you haven't already. I would appreciate that, and also share this live stream with as many people as possible so we can have a good amount of people join us for the FOMC meeting. Now, look, the drill is very simple, right? So if you come over to the FedWatch tool, and we're gonna go over to the Federal Reserve website as well. So this right here is federalreserve.gov. Anybody can go and check out all of this data. So you can go to the monetary policy meeting and calendars. It's a very, very simple routine. As soon as 2 p.m. hits, in less than 30 minutes, as soon as 2 p.m. Eastern strikes on the clock, we're going to refresh. We're going to get the statement right here. We're going to get these summary of economic projections right there. The first thing we're going to look at is the statement itself. And we're going to come over to the second paragraph of the statement, which is going to be right here. The committee seeks to achieve maximum employment and inflation rate for 2% over the longer run. Of course, that's the dual mandate. And then the third paragraph, second line, is when the actual action from the Federal Reserve is going to be. So what if we see a 0.25 percentage point here? So if we see similar language where the committee decided to lower the target range for the federal funds rate by a 0.25 percentage point to 3 3/4 and 4%. In this case, it's going to be 3.5 to 3 3/4. That means the Federal Reserve indeed cut interest rates. That's going to be step one. We're going to quickly come here. Third paragraph, second line. What is going to be the actual result of this meeting? And then quickly go back and check the summary of economic projections. The SEP, that's the most important document from this report, because that is the projection materials for 2026, 2027, 2028, and longer run. So 2025 is not going to be in the projection materials anymore. It's just going to be 2026, and that is really what's going to be moving this market, because all the markets really care about is what the Federal Reserve is going to do in the next year for interest rates. And right now, the market's pricing in for a rate cut, but just one rate cut. That's it. Just one rate cut, and actually, you know what? 2 rate cuts, one in June and another one in September. So market's pricing in for 2 rate cuts. And my prediction is also for the Federal Reserve to bring that number down from 3.4 to 3.2%. I think that is where the number is going to be once the SEP is released. Again, we'll find out in less than half an hour. So this right here is the current September summary of economic projections, and this is the number that we're going to be focusing on, 3.4. This is for 2026 as of September, and in my expectation here, this could drop down to 3.2%, which could be taken as a positive sign from the market for us to potentially rally higher. So again, thank you so much for joining, everybody. Hope you all are ready for this, and we're gonna listen in to Jerome Powell as well, and what he has to say for 2026, as there's only going to be 3 more meetings for him left. April is when his last FOMC meeting is going to take place. May is when his term comes to an end, and he is going to depart the Federal Reserve, and there's going to be a brand new chairman of the Fed stepping in starting May 2026. So if you come over to the 2026 calendar, we've got April 28th, 29th as the last FOMC meeting for Jerome Powell. And then after the new appointed chair, June is going to be their first meeting with only about 5 meetings in 2026 left. So hope you all are excited. This is it. This is one of those days where all the excitement of Jerome Powell, of FOMC, all comes down to one single hour. With the press conference and the summary economic projections and the statement as well. I've only ever known Powell in my past 6 years of trading. Will be sad. I know. I've been around since Janet Yellen as well in 2018 and prior to that. But yeah, it's going to be a big new chapter for monetary policy. And I think monetary policy moving forward in general, as I mentioned before, is going to take a little bit of a different approach. I think there's going to be some evolution of monetary policy over the years because, yes, the dual mandate is important. I think that's still going to be their target, but how they achieve that is going to be different. I think the tools they use are going to be potentially different moving forward because with the rise of AI, with the rise of technology, the problems of today cannot be fixed with the solutions of yesterday, right? So I think those are some things that the Federal Reserve will have to certainly give it some thought because as we're going through this huge upgrade cycle with the rise of AI, interest rates alone cannot fix if unemployment starts to go higher on the back of AI displacing jobs. So those are some things the Federal Reserve will, of course, have to discuss among many other issues. But yeah. Hope you all are doing great. Let's talk some stocks. Let's talk some macros. Let's talk some fundamentals, technicals. When you Google Powell, he's only wearing a purple tie. Blue and red makes purple. I don't think that's accidental. Good point. Good point. I think he's always kept a very neutral stance. Never really has commented on politics or fiscal policy, and I think it's not an accident. It's by design. And that's one of the reasons why in our yesterday's private live stream we were talking about once Powell gets out of the office and is no longer the Federal Reserve chairman, I think that's when we could see some opinions and some more analysis from Jay Powell, because right now he's been very, very diplomatic in his answers, and I really want Powell to kind of loosen up and give us the tea of what actually happens behind the scenes, and especially from a fiscal perspective, what his long-term thoughts are on the state of the economy, because there's a lot of concerns over the state of U.S. dollar, the rising debt, and we just witnessed a 10-year bond auction yesterday, $39 billion, not a big amount, but the yield awarded was a little bit higher than what the coupon was, right? The bid to cover ratio was pretty strong. We can in fact go over that right now. It was, I think, 2.5 for the 10-year bond auction. So let's just quickly go over to calendar. And this right here, the 10-year note auction, which happened yesterday, $39 billion, and 2.55 was the bid to cover, meaning the bids were 2.5 times more than where the supply was. And even then, we did get some yield awarded at 4.175. So even though we did have a healthy bid to cover ratio, yield awarded was a little bit higher. So when, it's all supply and demand, right? When the U.S. government needs to raise capital, they issue bonds, and rates will only go higher if investors are asking for it, right? If there's not a lot of demand, then of course prices come down and yields go higher because of that inverse correlation between those two. So yeah, so there's going to be a lot of interesting macro discussions over the long term for us to dissect together. All right, so Sunday Rambling says I'm buying Meta. So Meta is another stock that kind of traded down to our light buy, then bounced right back off here, 1.7% lower on the day. I did close my covered calls maybe a little bit too early, but wanted to capture that 75% profit. And 635 is going to be that next support level to watch for Meta. Anything sub 600, I think it's a great value for money there. So I'm watching 580 again, 590 again. I know a lot of members picked up a lot of shares sub 600, and we were always like kind of one-upping each other. If my order got filled at 600, someone else's gets filled at 595, and then we've got 590, and then it's like it's a good way to kind of push each other to get better and better prices. So support level 580 after 635, and that's also going to be below my light buy. So that's a level to keep in mind for Meta platforms. SoFi, I opened a CSP for $25 strike today on SoFi in the mid $26. So 24, 25, I think are pretty decent, good prices of accumulation for SoFi. And so $25 is going to put you right about how much lower from the current price? Going to be just over 7.5%. So I think it's pretty good. Rakesh, if you could tell me the expiration, maybe I can take a look at it a little bit more. But I think $24, $25 is a pretty good support level to watch for SoFi. It's a good area of accumulation inside this green rectangle. Pretty strong demand there for this stock. And I think 2026 with more rate cuts, I think it's only a net positive for the company long term for its lending activities. And I think with the refinancing of student loans, I think SoFi has a long runway of growth here. And it's still only $30-40 billion market cap company, right? So even if a 2x happens for SoFi, it's a $60 billion business, and it's still pretty small to mid-sized company, even at $60 billion, right? So yeah, SoFi, I think long-term, I continue to remain very optimistic, and I will continue to add more shares on any weakness I can find for the stock. So that's where we are. MicroStrategy is going to be very much linked with crypto, with Bitcoin more specifically. So as we've discussed in the past, I think if you are trading anything crypto-related, anything Bitcoin, Ethereum-related, you just got to be okay with that level of volatility, because if your risk tolerance, your volatility tolerance is not as high as what crypto gives us, then I think you're better off investing in non-leveraged ETFs or stocks for crypto, or just equities in general, right? Because these are going to be incredibly volatile. And support level for MSTR 166, 165, resistance all the way up to 232, 233. And most of that analysis, like I said, is going to be built on the back of crypto. A lot of these are derivatives, right? So derivatives are simply deriving their value from another asset or another underlying, linked commodity. In this case, if you are looking at MSTR, at the end of the day, it is deriving its value from the underlying asset, which is Bitcoin. Same thing with BITX, same thing with BMNR, same thing with IBIT, ETHE. A lot of these are derivatives by nature, right? They don't trade on their own. They don't have their demand-supply dynamics because the demand-supply dynamics work on the underlying index, in this case, Bitcoin and Ethereum. And all they're doing is they're trading off of it. And so that's why it's important for us to always analyze the underlying first and then look at the derivative that we're trading. So to give you an example, if you are going to be looking at SOXL as a potential trading instrument, doing the analysis on SOXL is not going to help you as much as analyzing SMH or SOXX, right? Because that's the underlying index that it's actually trading off of. So getting a better idea for support resistance levels and the technicals and the individual stocks that are within SOXX is going to be a better way to go about it than analyzing the leveraged section or ETF. Okay, too late hawkish rhetoric should do it, as Mark says. I bought more Uber at $83. SoFi, please, I opened, so we already covered that. CSP strike 9th Jan, collected about $100 in premium. So if you do the math there, if you collected about $100 in premium for $2,500 collateral, what is that going to be return on collateral there? So we're doing 100 divided by 2,500. That's a 4% return in a matter of 1 month, which is incredible. That's actually very good, right? So that's exactly what we target. Is we target something, closer to 1.5% to 2%. Me being conservative, but if you're getting 2 to 4% on a monthly basis, that's even better. And on an annualized basis, we're looking at 30+%, 40+% returns. Considering that the delta is low enough for a high probability that it's going to expire out of the money. So, as mentioned in the private live stream earlier today, that if you give me a trade that has an 80% probability of me making 30% plus per year, I will take that trade every single day of the week. Why? Because it's giving me both a high probability of success and a high acceptable, respectable rate of return. And that's exactly what I'm in the market for. I'm looking for something that's going to compound 20 to 30%. If I can't even compound my capital 20 to 30%, then I'm better off just looking at index funds and ETFs, right? So when I'm selling puts, the main idea is to collect premium that's going to be about 15, 20, 25% return on my collateral. Depends on everyone's objectives, of course, and what stocks you're trading. The more volatile, the higher the premiums. Less volatile, less premiums. But you've got to pick that for yourself. 30 days out, $25. Rakesh, $25 expiring on 9th Jan. Collected $100. How did you collect? Okay, it's right here, 80 cents. So you're already up on it, right? If you were to buy to close, you'd be buying to close at a lower price, selling to open at a much higher price, or $100 already. So yes, that is the option that you have. It's got a 27 delta, so it's got about a 73% probability that it's going to expire out of the money, 27% that it may end up in the money. So it's actually quite low delta for a price that's very close to the money. 7.5% is actually not that far off for SoFi, but maybe that's how the options chain is structured there for SoFi. But anyway, folks, we are less than 11 minutes. 11 minutes to go. 1-1. That's it. 11 minutes to go for the statement and the summary of economic projections to come out. Do me a favor, share this live stream with as many people as possible, because we're going to have Jay Powell take the microphone in less than an hour. So we are going to be very ready for whatever Jay Powell throws at us. And first things first, we're going to look at the summary of economic projections. We're going to look at the statement first and then come over to the SEP. I'm going to reload this page right at 2 p.m. Eastern, and we are ready to do this. So definitely invite more and more people so we can take a look at it together. This is indeed the last and final Federal Reserve meeting of 2025. Third and final rate cut, last and final FOMC meeting, wrapping up the year. Markets have been strong, and we are good to go here. So we're going to be looking at the statement first. For people who are joining us for the first time, we're going to look up this statement, third paragraph, second line. That's where they're going to mention exactly what they did, and then we're going to quickly switch over to the 2026 numbers. Now, what I want from all of you is make your predictions. 2026 interest rates, where do you think this number is going to be? Right now, it's 3.4 as of September, but I want everyone to participate and tell me exactly where you think this number is going to land. 3.6, 3.2, 3.1, 3, 3.9, 4%. Where do you think this number is going to be? Of course, if it's anything over 3.4, that means interest rates are expected to go up in 2026. If this number is expected to be going down, that means it's going to be below 3.4. So comment. I want to see at least 500 comments. We got over 500 people watching. Everybody comment exactly what their predictions are for where this 2026 number is going to be. They already revised it down from 3.6 down to 3.4, so they already penciled in for, an extra rate cut for 2026. Right now, there's only one rate cut possibility for 2026. Granted that we get one today, but where do you think this number is going to be moved to? Up or down? I see 2.5, 2%. That's too low. I mean, I don't think the Federal Reserve is going to get down there. 3% is a possibility. 3.25. So I'm expecting 3.2. 7. Then we've got 3.25, 2.9. 3.6 means it's going to be increased by about 20 basis points, meaning no rate cut in 2026. 3.2, Mark says. or Marcus says. Then we got Brian at 1.5, very unrealistic, Brian. 3.1 possible, 3.25 possible, 3.2, 3.25 kind of lands right there. 0% is not going to happen. FIFA, 3.2 again, 3.3, 3.3, 3.3. Is this a public live stream? I don't know if I can go back to coach after flying first class. Yes, this is a public live stream, Dave. 3.14, 3.1, 3.2, 3.1. Lots of low threes, right? Low threes to 3.2 is what I'm seeing. Mike says 3.5, a little bit of an increase. So I think they're mostly going to be moving it by 20 basis points. That's really where the range is. So, if it's at 3.4, 20 basis points from there is going to be either 3.6 or 3.2. Another 20 is going to be putting it down to 3. 3.1, 3.3 is kind of putting us right in the middle of that range. But Matthew says, end the Fed. If you join the channel membership, can you watch private lives, or is it only for Patreon members? So it's only going to be for members only moving forward, for Patreon members. So that's what we do every day now, is private live streams. And I'm going to be sharing a lot of data, a lot of spreadsheets, and answering every question. That's really our time now, community time, to spend together an hour and questions around everything. Anything and everything goes about the markets, finances, trading, investing, macros. I'm learning from you guys, and we're all learning together. So that's the whole point of doing it for members only, is so we can have a good, connected, quality discussion about whatever it is that you guys want to talk about. So, okay, so lots of low threes, 3.2, 3.15, and I would agree. I think low threes is what we're going to potentially end up seeing. So 3.2 is where my expectations will be. All right, everyone, 6 minutes to go. 6 minutes. Hope you all are ready. And what we're going to do is we're going to put the QQQs up here. We got the 5-minute chart. Then I'm going to put the S&P 500 over there. So also the 5-minute chart. And then I'm going to put gold prices right here. So gold is trading at just under 4,200. And then I'm going to put the 10-year treasuries as well. The 10-year treasury government bond sitting at 4.166%. We're going to put up the 5-minute chart. It's been pulling back a little bit, so we're going to keep these three things, equities, commodities, and bonds, all on the screen for us to look at exactly in 5 minutes and how the markets are moving as soon as that comes out. So we'll see. Let's do it. So yeah, you can check out the options here for Patreon if you are interested, Mark. And we'd love to have you on board. Any questions, you can email me admin@moneyvest.com. You can also do a Zoom call with me, and I can always walk you through your first options trade. That's also part of the courses and everything, is that I help you in your journey, and my goal is always to make you money. So first options trade is included with me that I can help you with. And the goal is really to get you to making some nice profits right on the first trade, so it pays for itself. The whole subscription pays for itself. All right. 3% surely, maybe 3.1. So Meta we covered earlier. Smith, if you want to go back on the live stream, check that out and come back to the live. I would really appreciate that, because we already covered Meta earlier. I reckon the markets have already priced in the hawkish tighten up bulls here. So yes, I think it's already priced in for the rate cut. I think that is already done. I think what the market's going to be looking forward to is what happens in 2026. As mentioned in my previous market updates, is the markets are very much forward-looking, right? We're kind of short to midterm forward-looking for the market. Market doesn't look back, obviously, and market doesn't look too far out also. We're kind of in the 3 to 6 month to as much as 12-month camp for most of the times where the markets are trying to understand what the earnings, what the interest rates, what inflation is going to look like next couple of quarters, and that's really where we're basing off of our decisions. That's it. Anything too far out becomes very uncertain. Anything more recent is already priced in. So that happy medium is 3, 6 months, couple quarters is what the market's kind of forward looking to. And so 2026, as I mentioned earlier, is going to be the most important number because that's going to be the next 3 meetings. And what the Federal Reserve does in the first quarter is going to be very important and different than what the Fed does in the next 9 months, because it's going to be under a new chairman of the Fed. So that's another lack of visibility from the Fed. So whatever Jerome Powell says, hey, 2026, we're planning on doing this, or we think we're going to have to do this to, reach our dual mandate, is going to be taken with a grain of salt, because he's only going to be focused on the first 3 months of the year. That's it. And even the projections and the forecast is going to be somewhat weighted, right? We're not going to be fully weighing that into the market, because it could change, and it will change. There will be a lot of revisions under the new Fed. Okay, a couple more minutes to go, and we are good to go here. Definitely love the focus and getting to all questions. No noise streams. Perfect. That's great. That's exactly what I want for all the members, is to be able to ask questions in real time, and for me to go over stocks and everything in real time. 100 tickers, but the actual tickers with some due diligence behind it. 100%. I love it. Okay, everybody. Volume has been really low. So Maxium, yes, since yesterday made no trades at all. Probably many like me. Volume's down. Volumes are down like 40-50%. Palantir is down 60% in volume alone compared to its average 30-day volume. So this is a very, very muted December. If I were to put a word, it's just been consolidating sideways. I mean, S&P 500 is literally about as flat as it gets. So 1 more minute left. 1 more minute. Share this live stream with as many people as possible, and we are good to go, folks. I'm going to reload this page right at 2 p.m. Eastern. Go over to the statement first, and then the S&P next. And we are all set going into the final minute of the final FOMC for this year in 2025. Let's do it. Hope you all are excited. It's always a good time. So I've got QQQs, S&P, gold, and 10-year treasuries. All 4 things lined up on the 5-minute chart. We'll see how the markets move. And as I said, 2026 numbers, what I'm really curious about. Cast your votes. We still have 30 minutes until Powell. So Jerome Powell doesn't start talking until 2:30 p.m. So this is just a statement and just the SEP. And then Jerome Powell takes the stage at 2:30 p.m. Eastern to answer all the questions from the media. All right. Into the final few seconds. A lot of people put down low threes. Here we go. A couple seconds. And I am reloading this page. Takes some time, but as soon as it comes out, here we go. Here we go. Statement is out. Page not found. What? Oh, here we go. So lowering the range of federal funds rate by 1/4 percentage point, 3.25% and 3.5%. So yes, they indeed lowered the interest rates by 25 basis points. When it comes to projections, they held it steady. They held it steady for 3.4. One second. I think this is not loading right now. Here we go. So 3.4 is what they have. This is for release December 10th, 2025. Yeah, that is today. And they held it steady, 3.4 and 3.1, 3.1 for 2026. So that's where we are. Markets pushing higher. We are up over 29 basis points. So we did get the 1/4 point cut. So the news is 1/4 point cut, 25 basis points, bringing rates down to 3.5 and 3/4. This right here, first couple seconds, the page did not even load for us. But this is the lowering the federal funds rate by 0.5%, 1/4 point, so 25 basis points, and bringing it down to 3.5 to 3.75%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. For summary of economic projections, they kept it at 3.4. So only one rate cut is what is being priced in for 2026. Only one rate cut so far, and then another 2 rate cuts in 2027 is what Jerome Powell and the Fed is pricing in. We did get that initial burst. QQQs are slightly negative, and S&P 500 is slightly positive, and we got gold slightly pushing higher as well. So that initial reaction was indeed a little bit positive on the back of that rate cut, and another rate cut penciled in for 2026. But all in all, we're still pretty flat. I think it's really going to come down to Jerome Powell and what he ends up saying. Yeah, as soon as we reloaded that page, it was not found. It wasn't found. Look, I opened that and it says page not found. I think it might have been just a system overload or something. But as soon as we got it to open, we got the quarter point cut, bringing it down to 3.5 and 3 3/4. And from an SCP standpoint, they kept rates exactly where they were. Nothing changed. Nothing changed on the median. You would think that something would update. I mean, it's for 2026 at least, because unemployment's been going higher. Unemployment's been creeping up, but then again, inflation's also been a bit more elevated. So they kept it steady. They did not move it, and the markets are not going to like that. We did get that initial burst to the upside, but I think we may just give all that back. I think we're just gonna come back. Yeah, no change for 2026. 3.4% for 2026 is that bearish? Cloud is asking. So, it really depends on how you view it, right? I mean, the markets were pricing in 2 rate cuts. So, yes, I mean, the market's expectations did get shattered a little bit, right? So you can see in the Federal Watch tool where markets were pricing in for 2 rate cuts, one in June, and then another one in September. So 2 for 2026, but what did the Federal Reserve give us? Just one, right? For bringing rates down from 3.6 to 3.4. So yeah, that is a little bit of a disappointment from the market perspective, because if the markets were pricing in for 2 cuts, the Federal Reserve is telling us 1. Yep, that is obviously a little bit of a unpleasant surprise. But what Jerome Powell says now, I think, is really what's going to matter to the market. I think no change means Powell is coming out hawkish, so we're getting the hawkish cut as we anticipated. Yeah, so we did get the cut. Whether it's going to be hawkish or dovish depends very much on Jay Powell's tone. And I think him not putting down, or really with the Federal Reserve and the committee itself, not putting down 3.2% or lower is kind of daring, because it's kind of, given the new administration and of course Donald Trump and always encouraging for more rate cuts, it could be his way of saying, like, look, I'm not going to cave. I'm not going to listen to what you want me to do. I'm just going to do what I feel is correct, because I was very confident that they were going to lower it down to 3.2 at least. At least another rate cut priced in, because the market was very much expecting it. It's not even like, where it's so at 41% probability that we're going to get a cut, and then another 32% probability that we're going to get another cut. 30% is essentially a pause. So yeah, Federal Reserve definitely playing with fire. Jerome Powell is definitely playing with fire right now, with a rate pause in 2026. After, of course, the first cut. That's it. That one and done for 2026 is what the Federal Reserve's penciled in. So yeah, it always does that at the start and then turns red by close. Yep. So we've seen that initial outburst in the markets pushing higher, and then by the time Jerome Powell starts talking, the markets reverse back to either being flat or being down on the day. But so far, seems to be gaining momentum. Volumes picking up as expected, and S&P 500 up over 19 basis points. We got QQQs up 7, and then year to date, well, on a seasonality perspective, we are, I think, break even. I think we might literally be break even right now. Here we go. We're just up 9 basis points after everything is said and done. Just up 9 basis points. Same thing with November. After all that volatility, the markets were only up 13 basis points. That's it. Stefan, 3M in Bali. I know. I don't know how you do it, man. Everybody who's watching us from the Southeast Asia, I really do appreciate you all. So yeah, let me know where you guys are tuning in from. What part of the world are you joining from? 4 p.m. in Argentina. Shout out to you. Thanks so much for joining. He's going to push Trump's buttons during his speech. Yeah, I think he's already playing with fire with the rates. But markets, look at them go. 38 basis points higher, 685 is where we're at. QQQ's 625 now, up over 12 basis points, finally green on the day. Gold pushing up to over $4,200 as well. So we got Jordan in the house, Zurich, Switzerland. Shout out to you, Boston. We got Georgia. Nice. Georgia, the state or the country? Italy, we've got Florida. Nice. 2 p.m. East Coast, Florida. Poland. California, we got Greece, Netherlands, Yemen. That's amazing. Seattle, Singapore, Los Angeles, Australia, Canada. Look how global this community is. That's what I love about it. It's just people from all over the world sharing perspective and their strategies and analysis and everything. The state. Okay, perfect. Colorado Springs, Haiti. We got Dallas, Prague. What time is he speaking? 2:30 p.m. So 2:30 p.m. Eastern. In about 22 minutes is when he's going to start talking. Relay, North Carolina, Hong Kong, Sydney, 6 a.m. Oh my God. I remember my time in Sydney. It's not good. Not good. And the markets are trading overnight. Norway, you got Cambodia, Indiana, Philippines, Cincinnati, Stockholm, Abu Dhabi, my neighbor. It's incredible. We got India. It's pretty late in India, Manish. I guess it's late many places right now. Lisbon, Egypt, Romania. That's awesome, you guys. Thank you so much for joining. Appreciate you all. And gold prices getting up to over $4,200 an ounce. The 10-year treasury is sitting at just under 4.163%. Volatility got crushed after the rate cut, down about 2%, trading down to 16s again. Bangladesh, we got Houston. What is your take on Fed, dove, or hawkish so far? I think the S&P does point to a slightly more hawkish leaning Fed because they didn't really change anything in the summary of economic projections, right? So GDP, they're expecting 2.3% growth now. That's a big adjustment to the upside. But the reason why I don't really pay much attention to these variables is because this is just a projection, right? This is just their forecast for what they think unemployment and inflation and economic growth is going to look like. And their forecast is just as good as any other forecast, which is at the end of the day just a prediction, right? So these are good to know that, okay, the Federal Reserve is expecting inflation to be at 2.4 next year, unemployment to be steady at 4.4, but I wouldn't put too much weight into it. The more important question was this number right here, because that's really what the Federal Reserve actually controls. They can control the interest rates, and 3.4 is steady compared to 3.4 from the previous meeting. And so take that for what you will, but I think it is, did you buy silver at 30? I did pick up silver earlier this year, February. So, that is, in my opinion, a little bit more leaning towards the hawkish side from the Fed. Palantir, let's take a quick look. Pushing 188, 189, getting up to that resistance now. So this is going to be that level for Palantir, whether it breaks out or not. And the volume's picked up quite a bit today. 37 million shares already traded. It's significantly higher than what we're seeing over the last couple of days, but it's coming up to that resistance now. And support level is going to be a 170 for Palantir. And SoFi also running up over 2.3, resistance all the way up to $30 for SoFi. Yes, everywhere in the world. I want to trade in Philippines and I live here in the USA. What is the best broker to use? You want to trade in the Philippine market? Is that what you're saying, Roland? If you can clarify, maybe someone can help. Microsoft and Meta are doing bad today. Yeah, Microsoft has been struggling quite a bit. It's been in this downtrending channel, lower highs and lower lows, and it's really just been struggling at this resistance of 494, 495. So that is a resistance for us to watch, which it's not able to break out of, also because of low volume. And support level is going to be at 464, 465 for Microsoft. And Meta, yes, Meta has been a stock that I've been accumulating a little bit, so we'll continue to pick up more shares if the opportunity comes in at sub 600 again. Yeah, Google is shaking up Microsoft because of their OpenAI exposure. I agree. I think that's been one of the reasons why Microsoft's been selling off and Google has been doing so well is because of all the progress Google is making with Gemini and all the other different models and the progress they're making in AI. Microsoft certainly, with the large investments, is having a hard time right now. Can you suggest good trader in Germany for trading US and Forex? Brokerage-wise, I think IBKR is the best. I think Interactive Brokers is going to be one of the best ones, I think. It's available in a lot of different countries, a lot of different places. You can trade equities, commodities, Forex, everything through that brokerage. So having a trust account for the assets, yes, I use Schwab, Alistair, I use Schwab, but for trust, DHK, I think it's best to consult with a proper, attorney and lawyer who can help you with a trust setup. I think there's definitely a lot of value in that. So it's something that can help you with asset protection, with proper structuring. There's, of course, a lot that goes into it, right? Yeah, it's more for security that something happens to you. But, of course, you can trade within that trust as well. Okay, Jerome Powell in about 15 minutes, everybody. We did see a nice little pop in this market after the 25 basis point rate cut. QQQ is also essentially flat right now. S&P is up over 27 basis points, and volatility slightly down about 2% at the moment. Anyone else buying Walmart? So Karthik, you should make a video about your story if you only get snippets about you. There's a 40-minute video of my story in the Psychology of Investing course. That is available for everyone, I think, on Patreon to watch, but there's a 40-minute video that you can watch over there. So let me see if I can go over it very quickly. So if I come here, I think it's one of the opening videos as well. Here we go. My story. This one. Psychology of Investing, Section 2. My story. It's a 40-minute video. I go over it in a lot of detail. Everything. Yeah. So that is available there. And the reason why it's part of that course is because it fits perfectly. It fits right in because we're talking about psychology and we're talking about just how we think about money and markets and trading and investing, and so how all of it ties in, and it goes over everything, like how I got involved in the field, why I got involved in the field, everything. So my favorite question is, what questions should we be asking? 100%. I agree. Give us a 30-second version of your story, 45 seconds. It's kind of hard to put it all into 30 to 40 seconds. But no, yeah, I mean, I've always been intrigued with the concept of money and investing and saving from a very young age. So really got into this as I got older. But I really did try my luck with professional soccer as well. I used to play soccer a lot, football, as I call it, not the American football. But yeah, I used to play. Like, that was my life up until 21 years old. But then I just pivoted because I was always interested in finance. I was going to school for finance, and so got into that. What is hawkish cut? Talking heads are pumping idea that is hawkish cut, but what does it mean? I think the hawkish cut essentially refers to the fact that we are getting a cut, but at the same time, we're not getting a lot of visibility into the future, and the future rate cuts are kind of uncertain and up in the air. And it also kind of signifies the idea that it does open us for a potential pause or even a hike later down the road. And then last but not least, in the statement, I haven't read it all the way through, but there is going to be a stance, from the Federal Reserve where they are going to, conduct the rollover from their balance sheet, because the balance sheet's been coming down as well, right? As they are no longer buying the treasury bonds, right? So back when the pandemic happened, one of the biggest things the Federal Reserve did was actually became one of the biggest buyers of the treasury bonds. So the U.S. government needed liquidity, needed money. Who was buying those bonds? The Federal Reserve. And they were essentially, ballooning their balance sheet to multiple trillions, like up to over $9 trillion in assets. And now, as a result, when they are maturing, they're not reinvesting that capital back into the market. So, it's quantitative easing is actively buying treasuries, because when there's demand, prices are high, yields are low, and that's one of the reasons why the Federal Reserve does it in the first place, is to try to control interest rates. They control interest rates directly by, changing the federal funds rate, which is the intra-banking rate, but then the open market rate, which is the treasury yields, they control that by buying a lot of bonds, making sure that prices remain stable, and yields also remain low and stable, because in times of distress, that's exactly what the Federal Reserve's goal is, to provide liquidity to the people. And liquidity only comes when interest rates are low. If interest rates are high, nobody's going to borrow. So that is over. And what the Federal Reserve is doing now is essentially letting all the treasuries mature, collect all the principal back, and they're not reinvesting anymore. So it is not quantitative tightening per se. Quantitative tightening would be more towards the lines of rate hikes and actively selling their bonds, right? Because when you're selling bonds, prices go down, yields start to go up. That's tightening the economy. So they're not actively quantitative easing. They're not actively quantitative tightening. They're doing a bit more passive way of QT, where they're just letting the bonds mature and get the principal back. And at the same time, they're kind of offsetting it with the rate cuts that we're seeing right now. So that's where we are. Did you grow up in a business entrepreneurial family? Oh, absolutely not. My parents are both from the service industry. My mom's a teacher. My dad's worked in a government job for about 35 years. 40 years. He just retired last year. So no, not from a business background at all. But yeah, no, I mentioned this in my story as well. I go over that in the video in quite a lot of detail. So definitely feel free to check that out. But yeah, super grateful, super blessed. Always, appreciate what I've had, what I do have now, and what I will have in the future, because I think gratitude is underrated. I think that's one of the reasons why there is always peace if you are grateful for what you have. I think the desire for wanting more never ends well, is what I've learned. Okay, let's go over to some stocks here. We got 10 more minutes until Jerome Powell comes on. But let's cover some stocks here. Oracle posting their results. Oracle posting their results after the bell today, I think. Yes, after the bell. $1.64 and over $16 billion is the revenue, but $1.64 is the earnings per share. What is the highest return you got in a year? So I tend to focus more on consistency as opposed to like making these big swings or big home runs in a year. So I would much rather take consistent 20 to 30% returns per year over multiple years than one year being over 100%, and the next year being 10%, and the following year up 70%, and the next year being down. Like for me, limiting volatility is just as an important goal as it is being able to perform well with returns. As I mentioned before many times over, I think a lot of people focus purely on return, on absolute return, and I think that's one of the reasons why, not to put any shade, but Kathy Wood and ARK Invest, they got really, really popular because of their absolute performance, right? Returns were incredibly high. I mean, we're talking multiple hundreds of percentages, but then that comes with risk, right? It comes with a lot of volatility, and I think one of the biggest lessons I learned from how what marks is risk-adjusted performance, right? Superior investing is not based on absolute returns. Superior investing is based on risk-adjusted returns. And that is how much risk, how much volatility are you enduring for the level of return that you're able to generate. If I'm able to match the S&P 500 every single year, if S&P is doing 8, I'm doing 8. If S&P is doing 10, I'm doing 10. If S&P is doing 2, I'm doing 2. But I cut my risk in half, I cut my volatility in half, that in itself is superior investing as well. So it's not just a question of absolute returns, but it is risk-adjusted returns, volatility-adjusted returns that I think what sophisticated investors need to be looking at. Because that's really what matters, right? If I tell you 100% returns, but that's going to come with a 90% drawdown, on paper, you'd be like, okay, sure, let's do it. If I can double my money, but I have to weather through a 90% drawdown, that's okay. On paper, sounds good. In reality, it's not going to be easy. If you're down 90%, it's not going to be easy to weather through it. So, okay, Jerome Powell coming on in about 7 minutes or so. QQQs are flat. S&P is up over 19 basis points. Gold is flat. Why is everything flat? Why isn't anything moving? Nothing seems to be moving. Gold, silver, flat. Tesla, flat. Apple, Google, Amazon up 1%. Great. Nvidia, down 1%. Such an exciting market. Such an exciting market this is. Yeah, gratitude, the secret to happiness, 100%. 100%. I agree with that. I thought for sure it would be violent in one direction or the other. It was violent in both directions. It went up, came right back down, and we're just like nowhere. So, 60 years old at heart. Man, I definitely do feel sometimes I'm very, very old. Old as in like, because I don't know, it's weird. Was that always a strategy, or did you take more risk when the portfolio was smaller? I think it's the approach to concentration versus diversification. I think we've had this discussion before. Concentration is what builds wealth. Diversification is what keeps it. Concentration is for growth. Diversification is for income. I think those are things that I will always sort of accept and agree with. Also because Warren Buffett and a lot of investors that we study, they all made their money through just 1 or 2, 3 very good bets that they made. Concentrated, high conviction bets. And that's what paid off. That's where the asymmetry was. And it doesn't matter the size of the portfolio, depends more on your objective. You can diversify with $10,000. You can be concentrated with $1 million. So it really depends on what your goal is. If your goal is income, pure income, and you want to do 7, 8, 9, 10% yield, diversification is your friend. You want to diversify across multiple income producing assets, whether that's real estate, dividend stocks, fixed income, bonds, things like that. You have a blended dividend yield. Or if you want to be pure growth, then that's when a lot of growth stocks and individual stocks and equities come in, options comes in. So, capital, in my opinion, should never be the limiting factor in your progress for investing. It's, you always work backwards. You always think about what's my end goal, what's my objective, and how can I get there? And that's when you start working backwards. And even in the psychology course, we talk about, what's your end goal and where you currently are, and then you're just bridging the gap. That's really what it is. You just have to figure out, okay, this is my end goal, this is what my starting point is, and I just have to bridge those two together. And so it's always kind of working backwards. Market has zero momentum, just treading water. Yeah, I mean, it's got nothing. We're just... S&P is up 16 basis points. Yay. What a great cut. from the Fed. QQQ's down 16 basis points. What time is Powell speaking? In about 3 minutes. 3 minutes. So I'll do a audio check here just to make sure that we're getting good audio. So let me just do that very quickly. I will share the conference. Okay, we have it going now. Perfect. So I'm just going to bring it over here. We're going to minimize this a little bit. We're going to put this right there. Perfect. So I'll do an audio check as soon as this starts. Should start in about a couple minutes, and then let me know if the audio is good. Good audio, bad speech. Yeah, so we're going to end the poll now for the tie contest. We got 38% red, 30% blue, 32% purple. Wow. I thought purple was going to win by a long shot, but it looks like red tie is what Jerome Powell is expected to be wearing. I think it's going to be purple. I think he's always worn purple. I don't think I've ever seen him in a blue or a red tie. But you never know. Jay Powell could give us some good surprises to close the year. All right, so I'm going to put S&P right there. And then maybe QQQs, we'll just put it down here. Both markets. All right, 1 more minute. Get as many people to join as possible. Jay Powell's last and final speech of 2025 coming in. Don't want to get that copyright. Let me know on the audio, okay? Just give me a thumbs up in the chat. Purple.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026, and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks? And what does your forecast look like? And where do you, ultimately, where do you think the bigger risk is? And it's very unusual to have persistent tension between the 2 parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately, having cut 75, and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about in a very positive way, just given the complicated nature of the situation we're in economically, but is there any point in which those dissents become counterproductive, either to, the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3. Is not a big data set, but you are right about those 3 cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's going to come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing the most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. they also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody, they have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. But really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know. But it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what? On
the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. There's depth. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs we'll just keep doing that. So you'll see, you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see, just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people. And that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy? My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
So there you have it, everybody. That was the Federal Reserve meeting, last and final for 2025. Market seems to be pushing higher on all of the guidance given by Jerome Powell on the back of balancing the risks between inflation as well as unemployment as well, and of course the probability for another rate cut in 2026. So hope you all enjoyed this live stream. Make sure that you drop a like and definitely subscribe if you haven't already. And again, link's going to be down below if you're interested in joining our MoneyVest community. Markets are indeed pumping higher on this rate cut. As always, happy investing. I will see you all in the next live stream. Take care.